Good morning, all. Today we will discuss about what is optimum capital structure, what is capital structure, and what are the factors influencing capital structure. So, what is capital structure? Capital structure refers to the composition of various long-term sources of fund. We all know that a company wants both long-term and short-term sources of fund to meet its long-term and short-term financial requirements. So capital structure is always related to long-term sources. So what are the main long-term sources? It includes equity capital, debt, retained earnings. So it is a mix of equity capital, retained earnings, and debentures or debts. Capital structure of a company refers to the composition or components of its capitalization, and it includes all long term capital sources or resources like loans, reserves, shares, and bonds. It is made up of debt and equity securities and refers to permanent financing of the firm. According to M.Y. Khan and P.K. Jain, the capital structure is the proportion of debt, preference, and equity shares on a firm's balance sheet. And what is optimal capital structure? Optimal capital structure is a mix of debt and equity financing that minimizes the cost of the company's capital and maximizes its shareholders' value. So, a company may have a mix of debt and equity, maybe, for example, 50% debt and 50% equity. So, debt is having separate cost and equity is having separate cost. Even retained earnings and preference capital is having separate cost. So, optimal capital structure is a mix of the long term sources wherein which the weighted average cost of capital will be lowest and it will be able to maximize the shareholders' value. Achieving an optimal capital structure is very crucial financial management objective for business. Now we will move to what are the various factors that influence capital structure. The various factors that influence capital structure is divided into two: internal factors and external factors. Internal factors include financial leverage, or it is known as trading on equity, risk, growth and stability of the firm, the existing cost of capital of the firm, cash flows, the retaining control, purpose of finance, and asset structure. There are certain external factors which influence capital structure of the firm that includes size of the company, nature of the industry in which the company operates, the investors, the legal requirements or legal obligations to be covered, the level of interest, the existing taxation policy, the condition of capital market, and period of finance. So now we have covered what is the meaning of capital structure. So capital structure refers to the mix of long-term sources of capital of the company, which primarily includes debt, equity, retained earnings, and other long-term sources. And what is optimal capital structure? It includes the capital structure in which it is able to reduce the or minimize the overall cost of capital.